Welcome to part 2 of Real Estate Economics webinar series. This week we're talking about the U.S. national forecast. This is part 2 of 2 today. We're going to go into forecast housing demand and supply patterns. First, let's look at median household incomes. These are national again, annualized. What we can see here is really a slow but steady increase in household incomes over the years. And what we can experience on a more localized basis is there are markets where these are growing much more quickly, markets where they're growing much more slowly. Inflation and real household incomes tend to vary quite a bit area to area, but these numbers are national. Now this will play into our valuation model later in this section, so just observe at this point that we've had sort of long-term steady growth in household incomes. Let's look at housing supply and demand. We have total jobs. We've talked about jobs in part 1. We have total housing supply in the middle column, housing demand, and a determination, representation of whether the market is over or undersupplied. If you start to look through the data, we had peak jobs in the left-hand column, 137 million, roughly 600,000. We talked about this in part 1. Then we had a huge trail off, huge job losses through the recession, the credit crash, the financial meltdown. That led to a huge oversupply on the right, where we were significantly overbuilt. Now, how's that overbuilt condition realized? The housing stock essentially is too large for the employment base because we've lost so many jobs. Is there any doubt that many people would have stayed in their homes if they had been able to remain employed? Of course they would have. So what happens when we lose those jobs in such large numbers is all those people can't afford their payments, and it makes it look that the housing market is significantly overbuilt, when in a steady employment environment we probably could have endured that. It really talks back to our public policy and sort of the subprime mess we got into. We're creating our own problems in some sense, and you can see the magnitude of those problems. If you look in the forecast period, we're gradually going to get back to about 137,600,000 jobs in 2013, and then start to pick up jobs somewhat more quickly. So we will undo, if you will, that overbuilt condition in the 2014 and 2015 time period. We haven't really done anything at this point to counteract our cyclical nature of the market, cyclical nature of interest rates, and government response. So we are still in a situation where the market contracts and expands pretty severely. Let's look at how that plays out graphically. As we talked to earlier, the supply of housing, you can see that in the blue line, that's permits. We all know permits are very steady. Most areas, most markets, most regions add supply in very measured numbers. Many markets remained undersupplied even during this last subprime era, when a lot of areas grew very rapidly. Demand for housing is shown in green, in the squiggly green line. That has a lot of seasonality into it, but demand for housing is being driven by employment. So when employment grows very rapidly, that green line shoots ahead and surpasses the supply of housing, and then retreats when we have recession and job losses. You can also see this cyclicality here also ties pretty closely to economic policy during time periods when we've had easy money, if you will. 2000, 2001, employment grew very rapidly. We had easy credit during the subprime era. Employment again grew very rapidly. And now, and during the forecast period, we've had QE1, QE2, a lot of easy money, and employment is ultimately going to respond to that and grow in the coming years. Let's look at trends in valuation. It gets a little bit more complicated, so listen carefully if you would. In the left-hand column, we have median home price. Those are actual numbers up to the forecast period of 2011 going forward. We have what we call an equilibrium home price. We'll explain how that's calculated in just a moment. We have 30-year fixed-rate mortgages. You can find those anytime you want on the internet or in the newspaper, so we know precisely what those are. These are all annualized numbers. If we know the mortgage rates and the median household incomes, we do know the long-term percentages of your household income that people are willing to pay out for housing. Those numbers tend to change very slowly, you might say glacially, so we can tell at any given time whether the market is spending more than typical for housing or less than they're accustomed to for housing. That draws a comparison of annual mortgage costs, which is what we see in the center of the page. Those are very low right now because interest rates are way, way down. And then we can look at equilibrium mortgage costs. That's what we would consider the market to be willing to pay under a normalized circumstance. Now, what has happened in the past few years here is when the government became involved in the mortgage market. You can see that data in 2007 and 2008 in the 30-year mortgage rate column. When we went from 6.04 to 5.04, mortgages and the amount of outflow for your house went way, way down. Interest rates made that payment much, much cheaper. That leads to the market being characterized as significantly undervalued. That improvement in affordability from decreased rates makes the market look way undervalued, and those numbers are quite large if you compare those to the median home price. Well, so people say, well, if the market's so undervalued, how come everyone's not responding and every house just doesn't disappear? Well, in a sense, they are. There's a lot of cash buyers out there. We've seen many markets that have 10%, 20%, even 30% of more cash buyers are active. Those people are recognizing the undervaluation and in many cases buying rental homes that they're going to immediately turn around, put into the rental pool, wait and watch for some future appreciation, then bring those homes back to the market. But by and large, the home buying public doesn't recognize that or won't act on it because they're concerned about their employment situation. They're down from one household member or two household members working down to one household member working. They don't know about the state of their industry or their particular situation. So this ties back to sentiment that we talked about in part one. So over the next couple of years, we have a severely undervalued market, really based on long-term trends in affordability. Let's see how that looks graphically. You can see from the 1990s all the way through about 2004, the supportable or equilibrium median home price and the historical price are pretty closely tied. Underwriters saw that. People really have their own ideas, too, about what they're willing to pay for a home. Most people don't like to get too overextended, and that's also reined in by lending policy. So what happens in 2004? The underwriting book goes out the window. People can acquire a loan much greater than they could ultimately afford. The only way for that excess demand to outlet itself or to manifest itself is through higher prices. So prices suddenly spike far beyond what was supportable. Well, we've seen how that resulted. That's all burned off. We've been in the payback period ever since, and that really draws down the forecast home price over the future. So you can see the spread between the green line and the blue line. That's the amount of the undervaluation. That's the spread between what people could afford and what they've historically been willing to pay. Those numbers are really at their apex, their peak, their maximum differential right now and through 2010 and 2011. Now, a couple other things are affecting prices here. During this whole cycle up to the forecast period, that's 1990 up to present, we've been in a declining interest rate environment. 30 years since 1980, interest rates have been declining. So if you take that interest rate decline, couple that up with increasing household income, and people have been naturally able to afford more and more homes, larger homes, more expensive homes over that entire time period. As we'll show in the next couple of slides, we think interest rates are reversing. So you can see, look at the green line. It shows a peak at about 2011 and then declining supportable median home prices. Homes will be increasingly less affordable as rates increase. That same household income, even if it's increasing, is not growing as fast as interest rates are increasing. That's going to put a little bit of a lid on supportable median home price, and gradually this undervaluation dissipates. Initially, it's not really a function of improved economic conditions, better employment, higher wages. It's really that the undervaluation is slowly being mitigated and is working itself off as the economic forces not only cause higher interest rates but bring up housing values. Here's the interest rate chart we talked about. You can see going back to 1990 we've had steadily declining interest rates. If you were to see this over a much longer time period, this 30-year number, or 30-year super cycle we're calling it, goes back to the turn of the previous century. Rates were last very low in the 50s. They rose tremendously into the 80s and now headed back down into about 2010. We see those increasing going forward. That 30-year pattern goes back even farther. So what we've got here in the next couple of years is increasing rates, which are going to act to raise the effective cost of housing. So let's talk through some summaries and just make some conclusions about what we've seen today. More areas are suffering, at least it certainly seems that. We've seen a tremendous drawdown in employment in some markets. Other markets are benefiting tremendously. I'm certain everyone has heard that Texas has a good employment market, Michigan doesn't. Parts of the South and the Sun Belt, some of those areas have done very well. Places like California haven't. Even within California, there are very, very strong markets where most of the job growth has been in upper incomes. Other places haven't. So you really have to know your local income levels, know your local employment base, and target those areas that are experiencing high growth rates in the right kinds of jobs. We know that housing construction is near an all-time low. That has actually helped us keep a lid on oversupply in many areas, but we're also starting to see in high demand areas there are definite shortfalls in the most popular home price ranges and home size ranges. In many markets, people have to make an extended geographic area just to find 4 or 5 detached programs at 2,500 square feet. We know that housing affordability is very close to an all-time high, and this severe overcorrection is well established in the numbers with long-term trends. High numbers of defaults continue. We've seen the foreclosure situation really drag on much longer than we ever suspected. Between robo-signing and the different moratoriums and all the putbacks to RMBS portfolios and that sort of thing, the whole foreclosure crisis has really drawn out a lot longer than we think. It's going to continue to be a problem for a couple of years here. At this point, also we saw a very, very weak period at the end of 2010, and it's already fading from memory, but we really had a confluence of a couple of events. We had the possibility of higher federal income taxes drove a lot of people to the sidelines. We had the tax credit in mid-year, drove people to the sidelines. So the end of 2010 was very poor. Transaction volume reflected that. Soon we'll be seeing market improvements. We think 2012 and going forward we'll see price increases driven by the offset of this undervaluation that we've been talking about. And we think market demand in the next cycle is really going to fall into a couple of key areas. Mature buyers, people with accumulated equity. Many of those are seeking low-cost retirement living locations. Mobile buyers, we talked about mobility increasing quite a bit. People are willing to travel for the high-paying jobs. We've seen that in the high-tech areas of the San Francisco Bay Area that has international draw to high-paying jobs. And then also just your basic international buyer. There's a lot of countries with accumulated wealth, and our real estate prices seem quite cheap. International buyers are buying in many of the trophy and high-demand markets across the country. Many of you know our services, residential market consulting, land optimization. Also explore our web-based information tools. You can look at what the employment situation is in your particular market area and make the same sort of judgments and determinations that we've talked about here today. Do the research, get yourself into the high demand market, high demand locations, and high demand product profiles. Here's our team today. Mark Badd, principal and founder. I'm John, presenting your national webinar today. We appreciate your attendance. Any questions, call our sales team, Judy Dewell, for new subscription sales, and call Sandy to make sure you're getting the most out of your subscription. Please join us in the coming weeks for our Texas webinar and our webinar on construction costs. Thank you again.